All right, what's up, everybody? Welcome to what has become the monthly Brian Hale strategic update. Whether we'll keep doing this monthly forever, we'll just see what kind of engagement we're getting, what kind of value we're getting, and we'll keep bringing the value as long as you guys want it. So I don't think Brian needs much of an introduction anymore, but just if someone is new in the business or you're new to this community, he's been a CEO for a number of the largest companies in the history of the mortgage business. And then a lot of CEOs and executives in power today have worked with Brian or worked for Brian. And today he is a coach to the executive, to a lot of executive teams, and he's very involved in the M&A that's happening in the market. And really what's most important is the guy reads a lot. He studies the market. He's been doing this for over 40 years. So he brings a lot of insight that's valuable. So Brian, it's been about 3 weeks since our last update. It is May 9th today. We'll probably push this live in our YouTube channel on Monday. So let's just say mid-May of 2024. What do you think are the most important economic things that have taken place since last time? And what do you think both loan officers and executives should be paying attention to today from a metric and data standpoint?
Yeah, well, thanks, Dave. First of all, you always make me blush with your introduction. You're generally too kind in your introduction. So, well, look, so a lot happened last week. Last week was an incredibly eventful week in terms of data. We had the Fed meeting, an announcement on where they were on interest rates. We had Chairman Powell's press conference, which always the markets tend to hang on every word and try to interpret every noun and verb that he uses, and inflection, his facial, tics, whatever, trying to figure out, can they read the guy? Is he BSing, or is he telling the truth, or what does he really think? And you saw the market literally move around live while he was doing the press conference. And of course, on Friday, and we had a lot of other data last week, but on Friday, we had the mother of all data, which was the April jobs report, right? The non-farm payroll report in terms of new job creation. And the going in expectation was up around 230,000 new jobs. It came in way below that at 175,000. That had been the first break in several months, where previous to that, over the last 3 months at least, the new jobs report or new job creation report and the unemployment rate had actually come in stronger than expectation, which everybody read as inflationary, coming in below at 175,000 still, by the way, and by almost any historical standard, 175,000 new jobs is pretty good. I mean, it's, almost 2 million, new jobs a year, which would be good. The good news is the markets reacted very positively to both Powell's comments on Wednesday and then, more importantly, the jobs report on Friday. And out of that, there was a second number that a lot of people didn't pay attention to. Two things got announced. One was 175,000 new jobs, new payrolls. And then two, the unemployment rate ticked up to 3.9, which was generally seen as dampening to inflation, right? All this is about both current inflation, expected inflation, inflation expectations over the next 6 or 8 months. And so everybody's reading the tea leaves on these data releases, trying to figure that out. The third piece of data that actually was part of the jobs report was the hourly income number, which actually came in fairly moderate compared to expectation and also the last couple of months, which would suggest, if the job market is less robust, that has limiting pressure on wage increases and what people are making. And we see all over the country new laws requiring higher minimum wage. We live in California. We've seen this $20 an hour in the restaurant space or the fast food space. All of those things, all of a sudden now it's $8 to buy a hamburger at McDonald's. I'm overstating that by some amount, but not by a lot, right? And so all that inflation's up. And then the other piece, Dave, that is buried in our inflation expectations is that new home or existing home sale prices continue to march up materially throughout the country, owing mostly to the fact there's a lack of inventory, right? I mean, we've talked about
right.
this, I think, every month we've chatted, and it continues to be the case because of the lock-in effect and other issues. and the fact that the country is probably somewhere between 4 and 5 million houses short in general, even if the market was a balanced market. And so you're getting this upward inflation in house prices, which translates, when the Fed calculates inflation on a monthly basis, they assume that everybody buys a new house and gets a new mortgage in that month, right? So they calculate it as if, what's the interest rate? What's the average sales price? What would the loan amount be? What does that look like as compared to last month or last year? And so all those things contribute to upward rates, but that jobs report and the income portion of it and the unemployment rate ticking up, Powell holding the rates constant and making some comments that he didn't see a rate increase in the future. The markets read that all as very positive, downward impact on inflation eventually. And so today we saw the 10-year, let me take a quick look here. We saw the 10-year trading today at 445, 446, somewhere in that range, down a little bit since the beginning of the week, and down materially from what the peak had been in that process. So there's a sense of lower rates. The third thing, or the fourth thing that Powell talked about in his comments was that they were going to slow down the sale of the balance sheet assets that the Fed holds on balance sheet, which had predominantly been mortgage-backed securities. So to the degree that they slow the sale of those, what had been happening is the sale of the Fed's balance sheet and the liquidation of it is crowding out new mortgage-backed security issuance from a market standpoint, right? There's only so many dollars to go around. And that had a depressive price impact on new mortgage rates or new mortgage securities raising rates. As the Fed throttles that back, there's more room for new issuance, and that should have a positive impact on spreads, which should have a negative, a reduction impact in interest rates. So a lot of gobbledygook. Short answer is big data week last week, lots to chew on, and we came through it with a general sense, as I've been saying for a while, that rates in the second half of the year are likely going to be better than they have been in the first part of the year. Although I still think there's a 10% chance of a rate increase still. And what should people be looking at? The data that comes out this month. We're not going to have a lot of data till the week of the 15th, right? This is kind of a dead week to some degree, which is good. We see the market improving a little bit. Frankly, there was some hope for maybe a ceasefire in Israel and, the Middle East piece, which has a downward effect on oil prices and those kinds of things. So everything we've seen the last couple of weeks would suggest lower inflation, thereby lower rates. So we need to look at anything that is contra to lower prices, lower inflation, lower rates, the economy slowing down. And there is a growing chorus of economists who think that we could slow down the economy materially in the second half of the year. I don't know if I'm in that camp yet, but to the degree the economy slows down and the job market tends to even out, there's still more job openings available today. It's like 1.6, 1.7 openings for every job seeker. Once that, and that's coming down, once that market kind of equalizes, I think we'll get real rate relief. And I've been saying this for a while. I think the market will lead the Fed. If the market sniffs lower inflation and believes the Fed can cut once, twice, or three times in the second half of the year, you'll start to see lower rates in a hurry because people are going to want to lock those in and try to pick up, issuance production, and we could see a rush.
Yeah.
What's of course going to happen, Dave?
Yeah. Well, it's going to happen. It's just a question of when is it going to happen?
Yeah, exactly. And the entire industry has thinned out, continues to thin out. And then whenever it happens, we're going to get a rush of volume and we're not going to have enough capacity.
Yeah. Well, and housing prices are going to continue to go up. I'm already hearing in most markets in interviewing top producers that they're dealing with multiple offers and it's competitive out there. And then to throw in the challenge, but to me, throw in the opportunity, NAR settlement looks to be moving forward, and you're even seeing big players like Zillow and it's getting real, like it's getting very real, which to me, anyone listening to this right now, make sure your database is locked and loaded so that as rates do come down, you're able to optimize that. Of course, here at Trust Engine, we got you. So we want to help you with that. But I think the bigger opportunity for the executives in the industry is how do we turn NAR into a great market share opportunity, and how do we position our companies so that we can be profitable in bad markets and good markets. And I think there's never been a better time to do that. I don't think I need to ask you if you agree, but that's something you and I share.
Well, I do agree. And I don't know if you sat in my present, I did the keynote on the last day of the gathering down in Scottsdale with Stan Middleman.
Of course, I was like practically front row.
Yeah, the founder and CEO of Freedom Mortgage. I appreciated Stan coming down. I invited him down to join me on stage with Clayton. And I appreciate Stan doing that a great deal. And, I loved kind of his opening barrage, which was, Clayton asked him, a bunch of mortgage folks in the room, what kind of advice would you have? And his answer was stop doing dumb shit. And, there's seems pretty obvious, but there's some pretty salient suggestion in that comment, which is, it's helpful if your revenue is greater than your expense. And there's a lot to that, but you got to start on that basis, because I don't think the market is going to bail us out this year. Even if we have somewhat lower rates in the second half, it likely won't be enough to, fix every issue that we have in the industry. And so you've got to be really focused on your own operation down to every originator. That's where, your data can help, and to make sure that your sales force is calling on people and working with people and marketing to people who actually sell real estate, as opposed to just people who are in real estate. Because I think these lawsuit issues, you're going to see some people leave the industry. I think there's a lot going on. There's still a lot of uncertainty about how that's all going to play out. And last but not least, the smartest folks on the real estate side that I talk to still believe that 2024 could actually be a smaller sales year than 23. But in almost no event does anybody think it's north of 4 million transactions, which is roughly what it was last year, just a touch over 4 million. The difference between 4 million and 4 million one isn't going to make a difference to the industry. It's really at the margins, right? So those are the issues. So you got to pay attention to anything that is data driven, that suggests inflation or disinflation or lowering inflation. That's the data you're looking for. And then secondly, how do you position all that? And to your point, Dave, look, if I was an originator today, I would be staying front and center in front of my past customers, my existing customers that are in the pipeline, to make sure they don't get poached and picked, right, in the process, my referral partners, and any other source that I have. This is not a year where it's going to be easier than last year. I think this is a year where you have to work harder than you did last year. And last year was, tough.
Yeah. Well, I don't know. I mean, the interviews I'm having with the best of the best, they're really doing well. They're doing a lot better this year than they were last year. And I do think the haves and the have-nots are widening.
It's always the case. Yeah, it's always we're seeing real estate as well.
Like last year, even the top producers were struggling. And I think the most elite loan officers aren't struggling as much. But let's transition. And
by the way, can I add one last thing that I think is a real positive that supports what you're saying? First of all, the elite loan officers, the ones that are really doing a good job and that did the spade work last year and are seeing the value this year, right? Whether it was working their database, improving their depth, who they're calling on. Listings are actually up materially. Depending on the market, you're seeing it up 19 to 20% around the country. And I think part of that is people are rationalizing finally 7% mortgages, realizing, look, maybe if I have to move, I got to do it. And secondly, smart originators are figuring out how to help people do that. And second and third, folks who want to sell their house are coming to that capitulation point where they got to put it on the market. And so you're seeing listings come up. I do think if we see rates come down, you'll actually see a flood of listings, which could have a moderating effect on sales prices. You could see sales prices moderate a little bit, not keep going up at the same rate, which would be a net positive for transactions.
Yeah, no, I agree. And I actually, had a slide. I don't know where that slide is right now, so I can't show it. Well, actually, I do. I just remembered where I put it. That supports what you just said, and then it's also a really good segue to where I want to, you know, really focus on a topic. So, first of all, I'm going to show a quick slide. It's a Housing Wire slide. I actually have Clayton Collins as my guest on tomorrow's Friday Mastermind. But this is a slide that he sent me, and you know, it really calls out what you said. These are
I have that
previous
slide.
years of listings,
Yep.
and and when I got this, I think it was a week or two that he sent it to me. It was I was surprised. I was surprised at just how much they were up, and they're moving in the right direction. Although I think it's safe to assume that if rates start coming down, you know, we'll either see that flatten out or we'll see that come back down. But TBD, TBD.
Agreed. I've got that slide. I used that slide in a presentation just last week, and
I'm
just
using it
speak.
all the time. Yeah, yeah. Well, we're
And this
both
is the other one.
data geeks.
Yeah.
So let me just walk you through this conversation. Part of this started in my mind at that Housing Wire event and watching you and Stan and really thinking about the industry and test my thesis. I actually had a call with Jim Deitch on Saturday morning, and we went through this, and I'm just like, am I crazy or am I right? And he's like, I think you're right. So you tell me and be candid. Is guys, you know, we are in a profitability crisis in the mortgage industry, and while things will get better, they will also get worse. And so we need to make some real systemic changes with how we operate. And I think, you know, specifically IMBs. And when you look at the amount of spend, you know, from 2016 to today, it's almost 4x. It's like three and some change X. So the investment in technology has increased. And by and large, Brian, the investment in technology is all about loan manufacturing. For the time that a credit report is pulled, that's the
Yep.
beginning of the loan manufacturing process and disclosures engine, till the time that it either closes and goes into servicing or it's sold. And so most of the time and money is obsessing over that loan manufacturing experience. And here we are, you know, we're not quite a decade from when the rocket went off in 2016, and I call it the arms race, the technology arms race started. But guys, this is another stark reality. Productivity per loan officer is down, productivity per underwriter is down, and and you would think like, oh, we're closing loans a lot faster. No, I
No,
mean,
no.
no, we're not. I mean, it's moving in the right direction, you know,
Well,
with the exception of this COVID bubble.
right.
It's, you know, but
It's somewhat back to historic norms. It's not this
yeah,
big leap
it's a
forward.
little, it's a little lower. Let's just give the, you know, the industry credit. So, so my thesis is we need to start thinking beyond loan manufacturing. And so like, let me give you an example. Like when I founded Mortgage Coach back in the day, I was reading Six Sigma books, and a term just, you know, when I founded Mortgage Coach, it all came from moments of truth. I learned about this thing called a moment of truth in Six Sigma, that there are certain touch points within your life cycle of a customer that have more impact than others. And I had, you know, in my thesis when I created Mortgage Coach was that when I'm given a family a fee worksheet, like that's a moment of truth. And I can't completely control what loan officers say or how they say it. And there's, you know, there is a, you know, a skill gap, and you know, some people are just more gifted than others. I go, but I could make it systematically a more robust, valuable conversation. And so, Brian, test my thesis on this and give me a sanity check. But I mean, I've had a bunch of lenders, and by the way, this is just one touch point beyond the transaction, that loan officers that are doing this, and it's not about Mortgage Coach, it's about they're asking better questions, they're delivering better value. they're like at one lender, 65 basis points more profitable. Churchill, I just talked to Matt Clark and he's run new numbers. These were from last year. You notice it was anywhere from, 19 basis points more in gross margin to 41 basis points. And it looks like it's north of 30 basis points of gross margin. So like my thesis is if we start redefining where the loan manufacturing process starts and that the industry starts really invest. I'm not saying we stop spending money and thinking about loan manufacturing, but if we really as companies start going, you know what, there's things happening in front of that loan manufacturing process and we need to do better training. We need to, yes, I'm going to say make a mortgage coach total cost analysis part of the loan manufacturing experience. I know you're investing a lot in training, and I don't know when you're going to roll out your new solution, but
June 21, I think.
In June. So we won't get in. First of all, any details you want to get into, we can. But my thesis is that if leaders start investing leadership energy and technology in front of loan manufacturing, they can be profitable today.
Yes.
Thoughts?
Yes. First of all, David, I hope you know this, and I've always been a fan. I think a lot of your tools exactly help enhance the process, and I think would be materially contributory to all the data you just walked through. There's a second aspect, and this is a little less mortgage coach centric, which is that it's also been my experience that some of the best reps in the industry have a tendency to seek tools like yours and then actually use them, right? And so I'm not sure if the tool made the rep better or the rep using your tool got better and is better. Either way, by the way, you come out with better, right? I mean, there's the answer.
Well, real quick, I want to insert something there. And by the way, nor am I, but what I do know is it is a way that you can manage a competency. And did the loan officer, here's your rate, here's your payment, here's your cash to close, or did the loan officer show options? Did the loan officer, there's just some checkpoints in sales development. And I think it's not about the tech. It's about there's steps in the process that these best of breed loan officers do, and they do them consistently. And that leaders need to start measuring that and obsessing on that in front of the transaction.
There's no doubt. Look, I don't want to get too far in the weeds here. You go to any other B2B sales function, and we're B2C mostly, but I think it applies. You go to medical supply sales, you go to technology sales, you go to the best salespeople who work for Oracle that do enterprise selling, those kinds of things. Those companies leave nothing to chance about the sales process. The tools, the CRM, the process, the approach,
you go to Nordstrom's. I mean, you go to the top
the best,
B2C sales organizations in the country.
Sales,
you go to Rocket. You go to Rocket, and
look, I don't know if you follow this guy, Brian Burns, who's he's on LinkedIn, a lot of social media with B2B sales. I listen to him often, and he's got a lot of, I think, very smart ideas.
By the way, Burns, Burns. Brian
Burns, he's a brilliant guy. One of the best sales minds that I've witnessed in a long time. And in any event, his deal is about how to make great salespeople better, right, in the process. And his view is you leave nothing to chance. You have a process, you have an approach. One of the things I think your tools do, and I'm not just flacking on Mortgage Coach tools or Trust Engine capability, at least you have a basis of a process, right? Whether it's the fee sheet, whether it's, whatever, total cost analysis, those kinds of things. If you overlaid that with a really defined process, you'd really have something. And the best reps that I've ever been around have a process. They get in front of a client, they push a little button on the side of their head, and it comes out, in a very organized, thoughtful approach that they've honed over time. You look at our industry, and we have 500,000 licensees, let's say a couple 100,000 of actually active originators, or 150,000 active originators. And if I had to guess, there's about 140,000 different sales approaches. Said differently, no defined sales approach. And then you take the bottom half of that group, productivity-wise, and they're confused by the question. And so I think, first of all, your tools give a framework, and that is better than no framework. And then if you can overlay that with a process, you'd really have something. And so suffice to say, I agree with everything you're saying here. I also believe that inherently good people tend to seek out tools and then integrate them into their system and make themselves better. And so I'm not sure if the productivity comes from one or the other. Either way, the output is better. And I trust that data. The data is intuitively correct to me.
Yeah, well, here's where Jim and I landed on all this. So first of all, I am Mr. Mortgage Coach, and I have that data point, and I do think that is an important tool and an important place in the mortgage experience that companies should put more technology and leadership around. And where Jim went with this is, we went down the Six Sigma route, and we're like, the difference between, like, if you're a pilot, the difference between a great, amazing, best of breed pilot, who's a black belt level 6 in Sigma player, and a bad pilot is like the difference between 5 and 6. And most loan officers are level 1 Six Sigma. I mean, who knows? They might not even be level 1 Six Sigma. And then when you really look
By
at
the way, I don't necessarily criticize the originator for being that, right? I think the organizations have to get better at helping people along that
and
path.
this is my whole thesis, is that we need to take some of the leadership energy, take some of the capital, create a standard, put your company name in it, and have a, level 6. This is where we're trying to get. And it has to do with some things within the transactional experience. Like, I've seen some really smart lenders that have some great loan officer scorecards that are measuring exceptions, they're measuring conversion, they're measuring underwriter touch points, they're measuring pull through from locks. They're coming up with like, hey, this is a good person. But most of those scorecards are all in loan manufacturing. And what I'm pushing the industry to do is, let's put some of those scorecards in front of loan manufacturing. And then let's have, this is our way of doing it. Let's train to that. And that literally you could turn your sales force into you could be profitable if you just put more leadership energy and more technology beyond loan manufacturing.
Yeah, look, I agree with everything you're saying. And I would just say this isn't about me, but I would offer this out to any company. And that, by the way, I'm not looking for a production leader job. Let me manage your sales force using data and a process for a year. I'll give you 90% of the increased revenue and profits. I'll take 10%.
There you go.
I'll do very well, right? Because in fact, this is not a knock on middle management. I have a lot of regionals that I know are really good, and divisional managers in the business, really good folks, and they do all the right things. But to be honest, if I was managing a sales force today, what I would want around me is less of people that do what I do and more around analytic type folks who can measure metrics, can put a scorecard together, can understand who my sales force is calling on and why, and then help redirect that sales force to people where if they did the same level of effort, the return would be better simply because the opportunity is better. And some of those things are difficult to crack, but if you don't try, you'll never get there. Secondly, they may be working with somebody who their company just went out or just got acquired or just, whatever. You never know when that opportunity is going to pop up, and opportunity doesn't have much of a shelf life. You've got to act when you see it, right? The process. And so having a data-driven, process-driven sales effort, and by the way, a lot of salespeople react negatively to that. If I've heard this once, I've heard it 200 times. Look, man, I've been doing this for 20 years. I don't need any coaching. Okay, cool. But there's a lot of people who can and do. And it's always been interesting to me that some of the best producers in the industry tend to seek coaching and to improve their effort and their work. And those two things are not unrelated, right? That the best producers tend to try to improve constantly and find things that make their business better, whether it's data, approaches, tools, whatever the case may be, to come off more professionally. I have a real kind of bug about our industry about professionalism. I think we owe our consuming public and our referral partners to be true pros in the truest sense of the word, meaning that we're educated and we're knowledgeable and we continue education. We're constant lifelong learners. We endeavor to understand all of what's going on around us. That's what makes a professional. That's why you go to a lawyer or a doctor, just, pick somebody out of the yellow pages and hope that your heart surgery works out well. Right. And so we need to be the same. And
Yeah, well, I wrote down data-driven, process-driven mortgage advisor, and a lot of those measurable steps that will drive sustainable profitability, regardless of whether rates are high, rates are low. If you have a sales force that is doing that, you will be profitable in every market going forward, and you'll kill it in these markets. So that was kind of the one topic I wanted to talk with you on. And I feel like we talked it out and gave the industry a push. And what closing?
I'll give you one other last closing thought on that one topic. Today, I just happened to be in LinkedIn. I noticed there's a guy he was a client of mine. I have immense respect for him. His name is Chris Stewart, who's the president of Place. And one of the most effective executives, I think, operating today in the real estate space. I helped them buy a mortgage company last year. And in any event, Stu was on today really wearing his mortgage hat. And you'll relate to this because you and I have talked about this before. What he was really haranguing people in a very positive way, because he's a positive guy, is this concept of how real estate agents cultivate a lead, maybe for 2 years, a buyer. They finally get them signed on a contract. Now they hand that lead over to you, Dave, as an originator. And your answer back to that prospective client that the agent has invested 2 years in and wrestled them onto a contract in a 7% market is, you know what, I'm busy right now, but here's what I'll do. I'm gonna send you a link to my application. Once you're done your work, I'll reach out to you and we'll have a conversation. I see this everywhere in the industry, and I think it's the most remarkably dumb idea as a sales approach. First of all, you say something to your referral partner by doing that, and none of it's good, right? You spent 2 years cultivating this, and I'm not handling it at the sense of urgency that you have. I think that's a bad idea. Secondly, the ability to get to a customer quickly, what you're almost saying to them is, look, let me give you some homework to do before I talk to you, because my time is valuable. So's the client, so's the referral partner. And I think we need to really think through. I think that technology of being able to send a link and have somebody go in and put in data is great. If I was an originator today, I'd be doing on a co-browse basis with the customer online and talk through and build that relationship and go deep and understand what's really driving them and those kinds of things. And I just see faux pas happening in those kinds of levels that, again, is about sales process. It's about coaching. It's about doing those kinds of things and trying to go deep and respecting the referral from your referral partner and having the same sense of urgency and care that they have. I don't know if that makes sense or not.
Yeah, it makes lots of sense. And it's Chris Stewart, but does he go by Stu?
Yeah, because there's the other founder of Place is Chris Suarez. So there's too many Chris's at the top, so they call him Stu. I think he's been called Stu most of his life, but it's
gotcha.
I'd be glad to introduce you to him.
No, I knew who he is, and they're the client, the lender they bought is a great client of ours, and I would love to know him. I truly consider what they're obviously one of the top innovators in housing now, because they are have a very innovative strategy. They've raised a lot of capital, and
Stu, in my view, is one of the best strategic thinkers about the industry in general. And so I endeavor to talk to him often and frequently, and it was great having him as a client. He's still a client, frankly.
I would love to meet him when you think the time is right. I'd love to meet him.
We'll end up at a conference together, I'm sure. Maybe we can catch dinner together. It'd be great.
That'd be great. So Brian, as we wrap up this, May of 2024 strategic update from you, is there anything you left unsaid? Is there any topics you want to cover before we rock it out? And when are you going to be announcing your new project? Like, when's that going to finally come out of the...
The marketing is going to begin very soon. We've been a little bit at the edges, dripping on it via social media, via some of my videos on Monday morning and those kinds of things. And we actually have prepared a number of announcements, and you'll see these. So it's called the Weekly Roadmap, right? My company is Mortgage Advisory Partners. You can see it on the wall behind me, MAP, Mortgage Advisory Partners. So the Weekly Roadmap is meant to be a single word to some degree. We think it's a verb. It's what you do, not what it is, right? In the process to participate in the Weekly Roadmap. It's going to be a live coaching call every Friday. We're still nailing down a few details. We've created a community site where people can come together. They'll get an automatic free subscription to my newsletter as part of it. They'll get some merchandise from us. It'll be recorded so that if they miss it, they can pick it up. It's portable. And one of the feedback that we've gotten from our couple thousand newsletter subscribers is just an immense need for interpretation of what's going on around them. And as you know, Dave, I've managed an awful lot of salespeople in my life, in this career, in this business. I've stayed in touch with many of the 45,000 originators that have worked for me through the years or worked with me through the years. And when I'm out, I was just down talking to a President's Club last Friday in San Antonio. And every time I come off that, I get an ask or a request if I would be willing to mentor or do an ongoing call, and I can't really scale that business on an individualized basis. And I think, look, you and your firm have done just an unbelievable job at introducing coaching. As you know, there's others out there that coach as well, and I'm sure they're all fabulous. But I also think I can bring a little bit of a unique perspective, but also what I can bring are guest speakers onto most of the calls, like a Stu Stewart that has this, catbird seat of what's going on in all three of our industries of real estate, title, and mortgage. Folks like Ivy Zellman, who is one of the most prolific housing analysts in the country, has been named the top female executive on Wall Street 4 different times, and brings that kind of analytics to the process and her perspective of what's going on in the market in general, but also in new construction and home builders. There's no home builder in America that doesn't have Ivy's phone number on their speed dial, right, to get a sense of what's going on in the market. I can bring a variety of other folks into that call as well. It's going to be an hour-long call. There'll be some open Q&A at the end for an additional 30 minutes. It'll be weekly. It'll be contemporary data, so like on Friday, we got the jobs numbers. On that call, if we would have had one on Friday, they would have got my view and interpretation of what that really means and what's happening. And this is about helping prepare people to go into the weekend. I think if you look at the data in the industry, a very high percentage of applications are taken on Friday, Saturday, and Sunday and Monday. And it makes intuitive sense to me because that's when people are out looking at houses. They need to get pre-qualified. They need to, they're finally transacting the business. People generally aren't looking at a house on a Tuesday night. They got a job and kids and everything else going on. And so this is about trying to prepare people for the weekend to be as knowledgeable as they can be. And also, to be honest, Dave, it's an opportunity for me to give back to the industry out of my, what's been I've been the, I don't want to steal DiMaggio's line, but I feel like I'm the luckiest man in the world, right? That I fell into this business 42 years ago, and it's been very good for me and my family. So opportunity to give back, opportunity. Look, I could end up with just 2 people on the other end of the call and I'll talk to them. I don't think so. And so it'll be a subscription-based call, but likely in the cost of a Starbucks coffee a day. And hopefully I can provide you better value than the coffee. No knock on Starbucks, I'm a fan. But maybe I can give you a little more value than keeping you awake. I'll try to do that as well. There's going to be a little humor. And to be blunt, there might also be a little ass kicking in the call, right? Because I think sometimes, I know when I was a sales guy, that was good. This all came from when I started in the industry. I had a boss every day, 7 a.m. stand-up call in his office. We watched the motivational tapes, got fired up. We talked about products, pricing, service. Go get them, right? Kind of thing. If you go to Wall Street, they have the squawk box call with the broker dealers every morning at, before the markets open. And the chief investment officer talks about what's going on in the market, how to position it, things to talk about. I intend to do the same thing on Friday. So I appreciate the opportunity. So if somebody goes up on my website, mortgageap.com, there's some information up there on a landing page that you can get some information and leave your data if you're interested. We're going to begin a really strong marketing effort. To be honest, Dave, we had planned to launch this the 1st of June. I'm actually going to Europe for a couple of weeks. My wife has a conference there. So I'm going to be out of the country, and I was a little nervous about launching it where I can't rely on Wi-Fi as, at the quality I'd want it to have. And so we've delayed it till mid-June. We'll announce the launch date. Tentatively right now, it's going to be June 21 on that Friday, and more to come. But I can't thank you enough for the chance to talk about it. But also, the last comments that I'll give you on this is, look, I think there's no easy button in our business. I agree with you. The very best people are up this year, I think, to some degree, Dave, because 80,000 originators have left the industry. Right? So there's consolidation happening at the originator level. And if we did 4 million last year and we do 4 million sales this year, there's fewer people feeding on that pie this year. So by definition, the folks who are still here should get more of that share. And the folks who are doing it really well and are real pros will get a disproportionate share. So the message in there is be a pro. Find out what those people are doing. Find out what tools they're using from Dave Savage at MortgageCoach and implement those things into your sales process. And it's always been a confusion to me. I've had billion-dollar producers sit next to $8 million producers. And the $8 million producer always wanted to earn what the billion-dollar producer was earning. But oftentimes they were unwilling to pay the price that the billion-dollar producer was willing to pay. And I've used this phrase before. It's on my wall just to my left. Everybody wants to go to heaven. Nobody wants to die. Right? People want things in life. And sometimes we're not really willing to pay the price to get them. And it's a decision you have to make. And by the way, everybody doesn't need to be a billion-dollar producer. That's a, as you know, that's a 1/10 of 1% type operator, right? I still know that guy, and he's running his own company today. However, whatever you define success as, for you to accomplish that, you simply have to decide what price are you willing to pay. And if the price you're willing to pay is not aligned with the price it takes for that level of success, time for self-inventory. And so that's really my message. That's what I'm going to try to do, is help people with those kinds of ideas. To be blunt, some of the call is going to be motivational. Some of it's going to be goal setting. Some of it might be emotional intelligence. I can bring speakers on to speak to all of those things, different origination strategies that I can expose. To be blunt, I really hope that I can have you as a standing guest, from time to time, to talk about the kinds of things you're seeing, how you're seeing success. And if through that process, people, come to your organization, hallelujah, because that's just me leading people to the trough. But I want a diversity of opinion. I want a diversity of ideas. I want real value. And I'm going to overlay it a little bit of humor, a little bit of honesty, and a little bit of ass kicking. And we'll see.
I love it. I know it's going to be a huge gift to the industry. I can't wait to see it. Hope I get the opportunity to be a guest here and there.
Look, I'd like to have you early.
You and I have talked about it, and I'm a big fan of.
And I'd love to have you back as frequently as you want to come.
It's going to be.
I'd be glad to offer a similar situation to what you and I've been doing on an ongoing basis, because I think, by the way, I think you're great, and you have a great way to convey ideas. But also, I honestly believe your tools are outstanding, and so I think that's a big part of making sure people are aware and understand what tools are available to them and how to deploy them.
Yeah, well, Roger that. It would be wonderful if we could somehow measure leadership and really, because it's all about leadership, and when it comes to leveraging tools, it's all about leadership. So I'm super stoked that you are.
I just add to that, to any company out there that wants to measure leadership, I kind of have a process for that, and I have somebody that works with me. We've done this for other organizations to come in to do a talent assessment. And part of that is trying to identify who your key high potentials are, who's really delivering today, obviously who your weak points are. You then have to decide how you're going to manage and deal with that as well as part of that process. But there are formulas and processes that you can go through to identify those pieces. And it all starts with the fact that I have a view, and others, I think, share this view. in any organization, there's typically somewhere between 20 and 40 positions that are so critical to your business. They may not be driven by title, they may not have a big title, but you take like a secondary market trader in a mortgage business, 80% of the revenue, 90% of the revenue of the company flows through those people's fingers, right? And so if you've got somebody in that chair who doesn't match the competency set that you need, your company is forever injured in that process. So we have a process called a 9-block that you can take people through and help them assess and understand those pieces, and also try to help coach on how to find, we should do a session someday, Dave, on executive hiring, because that's a passion of mine around that piece. I've had the good fortune to have some great staffs through the years, and I've assembled some really fabulous teams of people that were, Vanguard winners, named as top 10 women in the space. In past years, multiples of those people were on my staff. And it's not about they didn't work for me, they worked with me. I was the good fortune to try to keep up with them. It's the old Gandhi line, I must catch up to the group for I am their leader, right? And so, that's how I always felt. I just wanted people that, if anything, I had to hold the reins, not smack the reins, right? And
Right.
so I think there's a real process to that and a way to think about that. One of the mentors that I have, mentees that I'm working with currently, we spent a fair amount of time helping him understand how to pick talent. And there's this whole concept of, and I'll give, who's the guy that wrote Gung Ho and the 1 Minute Manager, Ken Blanchard. I'll give Blanchard all the credit on this, but there's this concept of essence and form of hiring great relationships in your business. And we should do a session on that, just talking about that.
Well, let's make that when we do the next update. I think let's make the topic leadership and some of the processes to up level leadership and how to find great leadership in your organization. So, I will make sure that's a topic.
If you make a mistake in one of those key roles, it'll take you 6 months or a year to unwind it. You're injured in the meantime, then you got to go out and replace. It's very expensive. It'll probably cost you some money to make the person go away. And so the selection process becomes so critical to your success. And I see people making mistakes on that all the time, in my view.
Well, any executive listening to this, highly recommend you get to know Brian Hale. He's not hard to find. He's all over LinkedIn. He is creating value on LinkedIn. You can reach out to him through social. His website, there'll be a link down below. He's mentioned it already a couple times, mortgageap.com. Check out the weekly roadmap. If you want to get on that list, it's going to be awesome. I know it will. And if you want to learn more about Mortgage Coach, Trust Engine, trustengine.com. And I try to be pretty active on LinkedIn, and I will be putting a number of posts. I'm going to really obsess over beyond loan manufacturing for a month or two until I feel like I've said what I want to say. And it will be data driven. I will be pulling out more data on this. I interviewed Jim Deitch. I've going to be talking to Garth Graham and Stratmore, talking to a lot of smart people to make sure that the ideas that we're recommending, they're well vetted. So thanks everybody for tuning in. Make sure you follow this channel, share this with your mortgage leader friends, and follow Brian. Take care, brother.
Thanks, David.